Have you ever wondered why the US dollar and Japanese yen dominate global markets? It's a financial showdown that's been unfolding for decades, impacting economies and our everyday lives. But how did these two currencies rise to such power? And where are they headed next? Stick around as we dive into the epic battle between the US dollar and the Japanese yen. You won't want to miss this. The history of the US dollar and Japanese yen. The US dollar, often called the greenback, didn't achieve its status as the world's leading reserve currency overnight. Its journey began in 1792 with the Coinage Act, at a time when the United States was a young nation struggling with financial instability. The act sought to standardize the currency, laying the groundwork for the dollar's future prominence. In its early years, the dollar faced stiff competition from established currencies, like the British pound and French franc. However, the dollar's real rise to power came in the 20th century, particularly during and after World War II. While the war devastated many of the world's economies, the United States emerged as a beacon of economic strength. This led to the 1944 Bretton Woods Agreement, where global leaders agreed to peg their currencies to the US dollar, which was backed by gold. This move effectively made the dollar the world's reserve currency. It provided a level of stability that other war-torn economies desperately needed, and it solidified the dollar's dominance on the global stage. These historical developments set the stage for the current rivalry between the US dollar and Japanese yen. Both currencies have been shaped by different historical events and economic policies, which continue to influence their role in global markets. Economic foundations behind the USD and JPY. The strength of a currency is not just a matter of historical significance or international agreements. It's deeply rooted in the economic health and strategies of its issuing nation. The US dollar, for instance, derives its resilience and global influence from the sheer scale and diversity of the American economy. With the world's largest gross domestic product, GDP, the United States has a robust industrial base, a highly developed financial system, and a strong consumer market. These combined factors create a powerful economic engine that supports the dollar's status as a stable and reliable currency. On the other hand, the Japanese yen is backed by a much different economic foundation. Japan, while having a smaller GDP than the US, still stands as one of the largest economies in the world, thanks to its technological prowess and advanced manufacturing sector. Japan's economy is built on exports, particularly in industries like automobiles, electronics, and machinery. This export-oriented growth model makes the yen highly sensitive to global trade dynamics. Both the US dollar and the Japanese yen represent their country's distinct economic realities. The dollar thrives on the strength of America's diverse economy and the strategic interventions of the Federal Reserve, while the yen, despite facing domestic economic challenges, remains a pillar of global trade and a symbol of Japan's technological and industrial strength. Together, they form two of the most influential currencies in the global financial landscape, each telling a story of resilience, innovation, and adaptability in an ever-evolving world economy. Factors that influence exchange rates. To understand the fluctuations in exchange rates between the US dollar and the Japanese yen, we need to explore a range of influencing factors. Exchange rates are like the heartbeat of the global economy, constantly reacting to changes in economic policies, market conditions, and investor sentiments. In the case of the US dollar, the US Federal Reserve plays a pivotal role. The Federal Reserve frequently adjusts interest rates to manage inflation or stimulate economic growth. When inflation threatens to rise, the Fed may raise interest rates to cool off the economy, while also encouraging saving and investment in dollar-denominated assets. This influx of foreign investment seeking higher returns boosts demand for the dollar, thereby strengthening its value against other currencies, including the yen. On the flip side, when the Fed lowers interest rates to spur economic activity, borrowing becomes cheaper, encouraging businesses and consumers to spend more. However, lower interest rates may also reduce foreign investments since returns become less attractive. which can weaken the dollar in comparison to other currencies. However, interest rates aren't the only factor at play. Inflation is another key element. If inflation in the US rises faster than in Japan, the purchasing power of the dollar decreases, leading to a depreciation of the currency relative to the yen. Japan, however, has long battled with deflation rather than inflation, which presents unique challenges and opportunities for the yen. Deflation increases the yen's purchasing power over time, making Japanese goods more expensive abroad, but also making the yen more attractive during periods of global financial uncertainty. Trade balances also play a significant role. The US runs a trade deficit, meaning it imports more goods than it exports. This imbalance can lead to a weaker dollar since more dollars are leaving the US to pay for foreign goods. Japan, on the other hand, typically runs a trade surplus, exporting more than it imports. This increases demand for the yen in the global market, as foreign countries need the yen to buy Japanese products, which can strengthen the currency. US dollar vs. Japanese yen, trade and investment. Trade between the United States and Japan is a key component of the ongoing economic relationship between these two global powers, influencing the dynamic interplay between the US dollar and Japanese yen. For decades, this trade relationship has been marked by a robust exchange of goods and services, with each country capitalizing on their respective strengths. The US relies heavily on imports from Japan, particularly in sectors like automotive and electronics. Major Japanese car manufacturers like Toyota, Honda, and Nissan have long been household names in the United States, supplying millions of vehicles annually. Japan's expertise in high-tech electronics also means that American consumers and businesses import everything from cutting-edge semiconductors to advanced consumer gadgets. This influx of Japanese results in US businesses and consumers constantly exchanging dollars for yen. Conversely, Japan imports a variety of goods from the US, with a particular focus on agricultural products, machinery, and aircraft. The US is one of Japan's main sources of items like soybeans, corn, and beef, and Japanese industries depend on American machinery to fuel their manufacturing processes. High-end aircraft from American companies like Boeing are also a vital component of Japan's transportation infrastructure. These imports necessitate a flow of yen back to the US, supporting the demand for the dollar. However, trade is only part of the equation. Investment flows between the two countries also play a critical role. The US and Japan are two of the largest holders of each other's government debt, with Japan being one of the top holders of US Treasury bonds. In fact, Japan holds more US government debt than any country except China. Future of the US dollar and Japanese yen relationship. As we look to the future, the relationship between the US dollar and Japanese yen will be shaped by a combination of domestic policies, global economic trends, and shifts in international power dynamics. In the United States, the Federal Reserve's ongoing efforts to control inflation and fine-tune interest rate policies will continue to be pivotal. With inflation becoming a global concern in recent years, the Fed's decisions will have far-reaching consequences, not only for the dollar, but for the global financial system. Interest rate hikes could keep the US dollar strong, as higher interest rates attract foreign investment. The balancing act between curbing inflation and stimulating economic growth is delicate, with the potential to either solidify or shape the dollar's global dominance. The greenback's role as the world's reserve currency remains another critical factor. Despite challenges from emerging markets in cryptocurrencies, the US dollar's status as the preferred currency for global trade and central bank reserves gives it a unique advantage if global demand for the dollar remains high. Particularly in countries seeking stability or in need of liquidity, the dollar is likely to retain its strength. However, geopolitical events, such as the rise of China and other economic powerhouses, may slowly chip away at the dollar's unchallenged position, though any significant shift would take years or even decades to materialize. Another factor is the potential for digital currencies, as both the US and Japan explore central bank digital currencies, CBDCs. The introduction of a digital dollar, or digital yen, could transform the way global trade is conducted, potentially making transactions faster, cheaper, and more secure. While it's still early days for CBDCs, their development could significantly impact the future of currency exchange and the broader economic relationship between the two nations. In the global context, rising geopolitical tensions, climate change, and shifts in energy markets could play a role in shaping the future of the US dollar and Japanese yen. Japan's reliance on energy imports makes the yen vulnerable to oil price fluctuations, while the US position as an energy exporter could bolster the dollar's strength in times of global energy crisis. If you found this breakdown helpful, make sure to hit that like button and subscribe for more insights into the world of global finance. Feel free to drop your thoughts or questions in the comments below. I'd love to hear what you think. Thanks for watching. And until next time, stay informed and stay curious.